let's try and get back on track with the arc of your paper. So I think that the next major theme was on the effect of dealer hedging. So I guess it's sort of this pair dynamic of invest this huge global carry trade, and then what that means to the dealer network that needs to offload the risk from investors that are constantly seeking positive carry. So I want to dive into that.
So when I started this section, a lot of it started actually going down a rabbit hole of high frequency trading. And what I found was, it's an incredibly opaque world. It's really hard to get what's a good detail of what's going on in high frequency trading. But a lot of the ideas of high frequency traders just pulling liquidity, you talk to high frequency traders over beer, they say, yeah, look, we're not a charity. We're not required to necessarily participate X% like they have in other markets. We can sort of come and go as we want, but that's only part of the story. The other part of the story is this idea that they're actually liquidity constrained, and they are operating as a high sharp strategy, operating with a tremendous amount of leverage to be able to facilitate all these trades. And a lot of that leverage is achieved by posting collateral that's security based. And so when markets get stressed, obviously the amount of leverage that they can use goes down. And so they're just literally prohibited from providing liquidity. It's a constrained problem. I think evidence of this is when Virtu Financial, is like around March 22nd this year, went out and did a presser saying, hey, we're trying to raise $400 million so we can keep providing liquidity. You're not doing that if you don't want to provide liquidity. You're doing that because you're constrained, right? Mm-hmm. I think that is a huge part of this. And I think we've seen sort of, I don't want to say it's, you've seen an aggregation of market makers, right? It's getting more and more power concentrated in fewer and fewer players. So if all of a sudden Virtu Financial is constrained from providing liquidity, the market is truly sapped of liquidity. And so that's a problem.
So hold on, I just want to dig into the mechanics of that. So, because this is what's going through my head. So I'm thinking about a Virtu, or I'm thinking about any kind of market maker, and they've got a certain amount of delta that they're willing to take on and that they're trying to hedge. But as volatility increases, the dollars that you need to maintain your target delta goes up, right? So I guess what's happening is vol increases. Just think back to March. You've got a massive expansion in daily range. Vol is increasing. In order to maintain your target delta, you need a lot more collateral on the books to collateralize that delta. Is this, am I working through those mechanics properly?
So I wouldn't even get into the world of delta yet, right? Just think of it purely from, I need $500 million to operate, and I need to borrow to use that $500 million. I'm going to post a bunch of collateral. The same way, I mean, I know you work in the futures world. When you start to see market stress goes up, what happens? Well, the margin you need to post goes up, right? Mm-hmm. You probably know better than me what happened with margin requirements. I know for us in U.S. Treasury futures, they went up significantly in March. Mm-hmm. And so all of a sudden, the amount of leverage you can apply goes down. Right. So even before we start talking about the issues of like what's going on with options market makers, just market makers in general and equities, for example, are going to be constrained as markets become stressed because the amount of leverage they can use goes down, and therefore the amount of liquidity they can provide goes down.
Yep.
So not even introducing this idea of sort of delta and other options Greeks. So that's sort of part of the equation. I think then the question becomes, well, who cares if liquidity goes down? Well, you care if again, going back to supply and demand, if the supply has gone down and demand has gone way up. So then the question became, well, who is demanding liquidity? And as it turned out, there are a lot of people demanding liquidity in these sort of market environments. What seems to have unfolded after 2008 is a huge amount of people who were forced up the risk curve have taken volatility contingent strategies. And I'm going to use a big framework here. Volatility contingent to me is going to mean you're either explicitly dealing in options, you have some sort of, and that includes structured products, you have some sort of trade where your portfolio is linked to volatility. So this is going to include CTAs. This is going to include risk parity. This is going to include things like variable annuities that use target vol indices. Or you're somehow vol correlated. So trend following, for example, you tend to see markets go down when volatility goes up, and therefore trend following strategies tend to sell at the same time volatility is climbing. It's also going to include some of the levered products, like the levered ETPs that have come to market. All of them are intrinsically tied to the volatility in the market. And as it turns out, all of these people need liquidity at the exact same time. And so you get this huge mismatch. And I think what we've seen, certainly there's a lot of players, but I think what's come forefront this year is the huge influence of options and option dealer hedging, both in the chaos we saw in March and the recent tech ramp up we saw in August. And happy to go into both of those if you want.
Yeah. So before we do, though, I think it's also worth noting that there are at least two dynamics at play here. One is, of course, the rise of volatility targeted type products, right? The CTAs, the risk parity, the structured notes. The other is there used to be a huge bid by fundamental price seekers in the market, right? The traditional sort of active value-oriented funds or players or institutions in the market that if the markets got too expensive, they were sellers. If the markets got too cheap, they were buyers, right? So they were lurking in the background. They were ready to provide liquidity when markets went too far in one direction or the other. And one interesting externality of this migration to passive is that it has sucked the air out of these sort of liquidity providers, the traditional value-oriented or fundamentals-based liquidity providers, right? So yes, we do have an increase in these pro-cyclical type strategies, and that's exacerbating divergent moves in both directions. But we've also had a major contraction in the market participants that would normally be relied upon to push against those divergent forces and to force markets back into equilibrium, right? And so it's this combined dynamic, I think, that is causing this Jekyll and Hyde type personality in markets. And one or the other wouldn't be sufficient, but the combination is highly destructive.
Yeah, and again, I'm always hesitant and reluctant to try to point to causality, but I think you point out something important, which is, again, you don't need to believe that either of these narratives is inherently the driving force, because you recognize that both of them together, it is a 1 + 1 = 3 scenario. That if people are moving to indexed products, all the securities are now being traded on a basket basis, right? All happening at the top of the order book because it's all price takers. It's no longer active managers who are trying to price individual securities. You can imagine that the friction in the order book has dramatically reduced. Now, all of a sudden, these market makers become liquidity constrained, and people try to take liquidity, and all of a sudden, there's no depth to the order book anymore. No one's willing to step in because everything's being done in a basket trade. And I think Chris Sidiel, who came on my podcast a couple of weeks ago, sort of said, look, the millennial way is to buy everything in a basket. You go to Betterment to buy a preset portfolio of preset ETFs that buy a preset selection of stocks. It's baskets all the way down. And who is left to actually buy individual securities? And it's a little alarmist to say all that. I get it. And it's very difficult to prove. But again, it's not about you have to be wholesale in on one story or another. These things certainly influence each other. And they have sort of, again, a pro-cyclical reflexive impact on one another.
And again, you got to constantly remind yourself and others that the price of every security is set at the margin. So it's the marginal buyer or seller. We don't know whether 50% passive is the point at which the marginal supply begins to dwindle at some sort of nonlinear rate, right? In which case you've got to chase the order book in order to be able to buy that marginal share using these marginal passive dollars that are flowing into the market day in, day out, and are price takers and are completely price insensitive, right? So
absolutely,
you can't model this. You don't know what it looks like. You just got to observe it and be able to adapt to the conditions.
Right. Right.
So how are the how was the huge increase in options strategies
Yeah,
changed this dynamic?
let me play that out a bit real quickly. So what we have seen, and again, full pause. The real expert in this area is Ben Eifert. He's had a couple podcasts on odd lots. He's been on my podcast. He's talking on Twitter all the time about this. Ben Eifert of QVR Advisors. Highly recommend you look him up for some amazing details in this space. But what we have seen in this sort of regime where institutions and individuals are stretching to find yield is a huge adoption of volatility selling strategies. And what I mean by that is things like covered calls and put underwriting. And so you're selling puts or selling calls. And what this chart shows is the average dollar volume on S&P 500 index options. And you can see that compared to 2005, how much the dollar volume has exploded and how much it's exploded in particular in what we would call sort of short tenor, 0 to 2, 2 to 6 month type options, which are, I'll get to, have sort of a larger influence on the type of hedging that dealers are going to have to do. And interestingly, the adoption has been so high that we've almost reflexively seen that this volatility risk premium that a lot of these institutions bought into, not only as a way to generate excess yield, but as a potential diversifier, has almost disappeared from the market. You compare the performance pre-2008, pre-2009 of the put right type indices or the buy right indices compared to their sort of post 2008, 2009 experience. And it is very, very, very different. And it seems to largely coincide with the mass adoption that occurred around 2011 to 2013 of institutions and individuals operating in this market and trying to harvest the volatility risk premium through selling calls and selling puts.
Right.
Now, the question is, right, what influence does that actually have on the market? Why should that matter? And I think what's really important to consider here is what's actually happening when you buy or sell an option. So as a very simple example, Adam, let's assume you want to do covered calls. And so you've decided you're going to sell some short dated out of the money calls to the market to try to harvest that premium. And I am going to be on the opposite side of the trade. Now, I am not an individual investor. I'm basically a market maker, an option dealer. And when I buy that call from you, I am now long the call. But as a market maker, I don't want to have a directional bet. I want to be completely neutral as to what happens to the underlying stock. I'm just trying to profit from that bid-ask spread. And so what I'm going to do is I'm actually going to hedge the underlying exposure. So what it means if I'm long a call, I have positive delta. We can sort of think of this as the beta of an option to the underlying security, that when the stock price goes up, the value of my option goes up. And when stock price goes down, the value of my option goes down. Again, I want to be completely neutral to that. So it means I need to, first of all, I need to short some exposure. But as the market starts to go up, that delta actually goes up. And so I need to sell more. And as the market goes down, my delta goes down and I need to buy back some of my short. And so we can think of this, if dealers are in aggregate, all of a sudden taking the opposite side of this trade of institutions who are selling calls at an unprecedented notional level, that all of a sudden every options dealer in the world, every time the market ticks up, these dealers are selling. Every time the market goes down, these dealers are buying. And you have this massive volatility reducing impact on the market. Now, this volatility reducing impact is sort of pro-cyclical in a way. And I want to I'm going to tie it into some of these other volatility contingent strategies in a second. But so these institutions start to sell options. And as this space gets more and more crowded, that premium gets thinner and thinner, right? The implied volatility goes down. And what that does is it means that the next institution that steps in, if they want to generate the same yield, they actually need to now sell more options. So if the space becomes even more crowded and more open interest occurs that dealers have to hedge. Now what happens is the dealers are hedging these options, more and more and more and more of them, and it's reducing realized volatility. Their trading is explicitly reducing realized volatility that's occurring in the market. And I would argue this is largely what happened in 2017, why we saw such unprecedented low volatility levels. Now, pause here and again, now think of all these volatility contingent strategies. Things like your target or capped volatility variable annuities, your CTAs or risk parity strategies, who are all tied to sort of volatility levels in the market. Well, what happens is realized volatility goes down. All of a sudden, your target volatility strategy starts increasing its leverage, right? And so we can actually model this. So on the x-axis, what I have modeled is sort of an estimate of dealer hedging pressures, where the negative dollars mean that every time the market goes up, the dealer is selling. Every time the market goes down, the dealer is buying. And on the y-axis, what we have is an estimate of leverage in an S&P target 10% volatility strategy. And we can clearly see that the more negative hedging pressure that the dealer has, the higher the notional leverage exists in this strategy.
So this is really this chart's a proxy for showing that the size of the negative the size of the negative dollar amount of dealer hedging pressure is or explains market realized vol, right?
Exactly.
So and by virtue of that, increased leverage for vol contingent players.
Yep. Or at the very least, highly correlated. I would argue there's a stronger causal link here in the influence, right? But you can see dealer hedging pressure as it gets more and more negative, right? Potentially suppressing where, every time the S&P goes up, they sell. Every time the S&P goes down, they buy. That driving down realized volatility drives up the leverage needed by these volatility contingent strategies. And so what you get is as the market becomes more and more compressed in its realized volatility, you're creating much more risk in the left tail. Because if sudden fragility, for sure, as soon as that market sell-off occurs from that exogenous event, all of a sudden, all these strategies have to de-lever simultaneously. And so that becomes a huge influence on sort of market environments like March, where you have running into March very low vol, huge levered positions that all of a sudden have to dramatically unwind all at the same time.
Right. And so that's the volatility compression regime is one side of the coin, right? And that is an equilibrium seeking dynamic. But there's a different dynamic, right? When dollar dealer gamma hedging pressure flips to a positive sign, it becomes a positive feedback mechanism, right?
Absolutely. So the other side that occurs very frequently is, I mentioned sort of there's call overwriting and put underwriting. Well, you also have a lot of people who are buying puts as protection. And this is evidenced by sort of the skew that we see in the volatility curve. And so a lot of people are out there buying puts. And so what that means is the dealer is actually short a put. That as the market goes down, that dealer is going to ultimately potentially owe money on that put. And so what it means is that they have to hedge that exposure by shorting stock. Conversely, as the market starts to go up, they end up needing to cover that. And so they buy more stock. Now, what seems to happen is that these puts that are bought tend to be further out of the money and further dated in such a way that as markets sort of gyrate normally, there doesn't have to be a lot of hedging that unfolds, that dealers can more or less ignore them. And they're focused almost entirely on these calls, the calls that are very short dated, 1 or 2 months out, and much closer to at the money than these puts are. As the market starts to sell off, let's say this exogenous event hits and everyone reprices the market downward 10%. All of a sudden the calls are so far away, they don't really matter anymore. And all of a sudden the puts become the influence. And again, they have the exact opposite impact, that as the market goes down, all of a sudden dealers have to sell more. And as market goes up, the dealers have to buy more. And all this is occurring simultaneously to all these volatility contingent strategies delevering. And so you have market makers who are now constrained in the liquidity they can provide. you have option dealers who are all now trying to chase stocks up and chase stocks down. And you have all these volatility contingent strategies that are trying to delever at the same time. Everyone's suddenly rushed to the side of the boat trying to demand liquidity from the market when liquidity no longer exists.
Right. So as the moneyness of the puts, or as the puts become closer and closer to being at the money, the delta of those puts gets larger and larger at an accelerating rate. And so the dealers have to sell stocks into a declining market at an accelerating rate in order to maintain their delta neutrality on their hedge book, right?
Yep.
And
Yep.
this is the thesis for what we saw during some of these cascading episodes in March, for example.
Precisely. So right around early March, sort of estimates of dealer hedging pressures, dealer gamma is what it's called, flipped sign. And then all of a sudden, volatility explodes. You saw intraday, it just towards end of day, everyone's chasing, whatever direction the market moved. And then right around March 23rd, everything starts to die down. Volatility starts to die down. Well, what happened? Well, there was options expiration. A huge amount of those options expired, and the dealers no longer had to hedge as much. And all of a sudden, a couple of days later, the sign of dealer gamma flipped. Volatility kept going down. And so then what happens? Well, realize volatility keeps going down. Now, all of a sudden, a lot of these volatility contingent strategies are going to start buying again, and potentially creating now a reverse upward pressure to reapply the leverage that they had taken off.
And what's been astonishing in this market, right, is just how quickly volatility expands and contracts. It's the character of volatility over the last 3 or 4 years is completely different on a variety of different, through a variety of different prisms than any environment that you saw previously. And so, I mean, it certainly makes sense to try and dig into some of the causal mechanisms of that.